There's a silent geopolitical fracture happening in the crypto markets right now that almost nobody is talking about. While you are staring at the daily price charts and worrying about the next 5% move, the fundamental structure of global liquidity is being rewritten behind closed doors. We are witnessing a massive divergence between the United Kingdom and the United States that poses a direct threat to passive holders. If you are sitting on your hands waiting for the next bull run without understanding this regulatory war, you are positioning yourself to be the exit liquidity for the institutional giants. In the next 8 minutes, we are deconstructing the raw evidence that proves retail traders are being squeezed out, while smart money is front-running the greatest supply shock in history. Welcome to the briefing. Let us look under the hood at what is actually happening with the global flow of capital. For the last 10 years, the narrative has always been that the United States would be the heavy hand of regulation, while Europe and the United Kingdom remain the hubs of innovation. That narrative is dead. The data is screaming something entirely different today. We are seeing a complete inversion of the status quo, where the United Kingdom is actively suffocating retail access, while the United States is quietly laying the red carpet for institutional dominance. Let us start with the United Kingdom, because the situation there is far more critical than most people realize. Since the Financial Conduct Authority implemented its new financial promotions regime in late 2023, we have seen a dramatic drop in liquidity for British pound trading pairs. This is not just a standard regulatory adjustment, this is a systematic choking point. Major exchanges have been forced to pause new user registrations. Banking giants like Chase UK and others have outright blocked payments to crypto exchanges. When you look at the on-chain data, the volume of British pounds flowing into Bitcoin and Ethereum has dropped by over 40% in the last 6 months alone. This is a metric that should terrify you if you believe that adoption is a straight lineup. It reminds me of the early signals we saw right before the China ban in 2021. The government is not banning the asset class itself, but they are severing the on-ramps and off-ramps that retail investors rely on. This creates a liquidity vacuum. When you remove the retail bid from a major economy like the United Kingdom, you leave the market vulnerable to sharp downside volatility because the order books become thin. However, here's the kicker that changes everything. While the United Kingdom is tightening the noose, the United States is doing the exact opposite under the guise of regulation. Do not let the headlines from the Securities and Exchange Commission fool you. Look at what the institutions are actually doing. We are seeing the most aggressive accumulation phase in the history of digital assets coming out of United States-based entities. Since the approval of the spot Bitcoin exchange-traded funds, the net inflows have been staggering. We are talking about billions of dollars flowing into custody every single week. BlackRock and Fidelity are not just buying the dip, they are swallowing the entire daily supply of mined Bitcoin multiple times over. Historically, when you see this level of divergence between retail suppression and institutional accumulation, it leads to a massive price squeeze. The institutions know that the United Kingdom and other jurisdictions are shaking out the weak hands. They are happily buying every single Satoshi that a frustrated retail trader sells. If this level of deep dive data helps your strategy, consider supporting the analysis by subscribing to our inner circle so you never miss a critical update. Now, let us get back to the evidence. We need to talk about exchange reserves because this is where the story gets undeniable. If we look at the total balance of Bitcoin on exchanges, we are currently sitting at levels we have not seen since 2018. Think about that for a second. We have wiped out 5 years of exchange inventory. In the last 30 days alone, we have seen over 50,000 Bitcoin move from exchange wallets into cold storage or custodian wallets. This is a supply shock in motion. But here's the nuance that the average trader misses. Most of these outflows are coming from United States-based platforms like Coinbase Prime. This tells us that the buyers are not day traders looking to flip for a quick profit. These are strategic allocators with a time horizon of 5 to 10 years. They are removing the asset from circulation. Meanwhile, in the United Kingdom, the friction to buy is at an all-time high. You have to pass competency tests just to open an account. You have cooling off periods that prevent you from executing immediate trades. This creates a psychological barrier. The casual investor in London gives up, while the hedge fund manager in New York doubles down. This is the definition of a wealth transfer. We are moving from a distributed retail-led market to a concentrated institutional-led market. The implications for price discovery are profound. When the supply in exchanges gets this low, the price becomes incredibly sensitive to demand shocks. We saw this happen in late 2020 during the corporate treasury era when MicroStrategy started buying. The difference now is the scale. We are not talking about one company. We are talking about the entire United States retirement and pension system, slowly gaining access through exchange-traded funds. The United Kingdom regulators are trying to protect consumers, but in reality, they are locking them out of the best-performing asset class of the decade right before the institutions mark up the price. It is a tragedy of policy. But as a strategist, you cannot trade on emotions or politics. You have to trade the reality of the flows. and the flows are telling us to look west. The United States' ambitions are clear. They want to control the rails of this new financial system. By approving the ETFs and integrating crypto into the traditional banking stack, they are ensuring that the dollar remains the dominant quote currency for digital assets. This is a strategic geopolitical play. If the United States can capture the liquidity, they capture the control. The United Kingdom, by isolating itself, risks becoming a crypto wasteland, forcing its citizens to use offshore, unregulated platforms just to get exposure. This brings us to a critical data point regarding stablecoins. We have seen the market capitalization of stablecoins pegged to the dollar rise for 6 consecutive months. This is pure liquidity waiting on the sidelines. Historically, a rising stablecoin market cap is a leading indicator of future volatility. It is dry powder. But interestingly, the volume of stablecoins settling during United States trading hours has hit an all-time high relative to Asian and European trading hours. This confirms our thesis. The center of gravity has shifted. The crypto market is becoming Americanized. If you are finding value in this breakdown of global capital flows, make sure you hit the notification bell so you are alerted the moment we release our next briefing. Now, let us discuss what this means for your portfolio strategy. You have to understand that we are entering a period of low liquidity but high institutional demand. This is a recipe for explosive moves. The sell the news event that everyone feared with the ETFs is over. Now we are in the accumulation phase. But because of the regulatory headwinds in places like the United Kingdom, the retail frenzy has not started yet. This is actually a good thing for you if you are paying attention. It means we are nowhere near the top. Retail euphoria usually marks the top of the cycle. Right now, retail is being blocked, banned, and discouraged. Google search trends for Bitcoin are still at bear market lows. The average person on the street is not talking about crypto. They are worried about inflation and their bank accounts being frozen. This creates a massive divergence between price action and public sentiment. Smart money loves this environment. They can accumulate without the noise. However, you must be careful. With the United Kingdom and potentially the European Union tightening rules, we could see sudden regulatory enforcement actions that cause short-term panic. If a major exchange is completely banned from operating in the United Kingdom, we could see a flash crash as users rush to withdraw. You need to be prepared for that volatility. Do not keep your assets on an exchange that is in the crosshairs of regulators. Self-custody is not just a slogan anymore, it is a survival strategy. If you're in the United Kingdom, you need to be looking at decentralized options or fully compliant platforms that have already jumped through the hoops. If you're in the United States, watch the flows into the ETFs. As long as those inflows remain positive, the floor price of Bitcoin is rising every single day. We are looking at a mathematical inevitability. The issuance of new Bitcoin has been cut in half. The demand from Wall Street is accelerating, and the regulatory moats in other countries are ensuring that the supply remains trapped in the hands of the few who can access it. To wrap this up, do not let the headlines regarding bans scare you out of your position. These bans are actually a signal that the asset class is becoming too powerful to ignore. Governments do not ban things that are irrelevant. They ban things that threaten their control over capital. The United States has decided to co-opt it. The United Kingdom has decided to fight it. History tells us that capital always flows to where it is treated best. Right now, that flow is heading into the institutional vaults of New York. Position yourself accordingly. Do not be the person selling your coins because of a regulatory headline, only to watch BlackRock buy them and sell them back to you at double the price in 2 years. Stay focused on the data. Watch the exchange reserves. Watch the stablecoin dominance. And most importantly, watch the divergence between retail fear and institutional greed. That is where the opportunity lies. Disclaimer: I am not a financial advisor. Everything discussed in this video is for educational and informational purposes only. Crypto assets are highly volatile, and you should always do your own research before making any investment decisions.